The United States has now officially ended what's known as quantitative easing. Economists argue that this could have positive consequences for the developing world as well as for the newly emerging economies. To discuss this further, we're now joined in our Johannesburg studios by, of course, our regular resident Geo-economic analyst, Mr. William Gumede. As always, it's a pleasure to see you, so thank you very much for coming. Now, what spurred America to pursue this policy in the first place, and was there really a need? And maybe you can just, going back, what really is quantitative easing?
Absolutely. I mean, essentially, the American economy after the euro and the global financial crisis have been really in trouble. So, they changed their monetary policy to make it easy for local companies, to get money from banks, and they also lower the interest, so you don't pay as much back in terms of interest in order to create jobs and to stimulate the economy. Now they've argued now that the American central bank is now arguing, look, the American economy is getting better now. Let's ease on this policy.
Now, who does it really benefit? I mean, does it just really benefit big business, or does the regular man actually feel, the benefits of quantitative easing?
Of course, there's always going to be controversies. I mean, there's some people who actually argue, look, instead of spending so much money, really, on this monetary policy, why doesn't the government just give individuals the money? I mean, that one case scenario. So this is, I think, is open for contestation. But now, I think the real fear is in the developing world now, and especially emerging markets, African countries, particularly African countries whose economies are very integrated with the world economy, is that, so now that the Americans are easing quantitative or tapering, what will now happen is that a lot of the investors will move their money out of emerging markets back to the industrial world. Now that happened in January. If you remember January this year, what happened is that the American central bank announced that, look, what it will do is they're going to ease out tapering a little bit, not fully abandon it, but just easing out. And then what we saw a lot of money moving out of emerging markets. I mean, also South Africa, Turkey, Brazil, and so on. And a lot of developing country currencies were hit.
Now, I mean, it seems like a very complicated concept, this quantitative easing. Is there perhaps a simpler way to achieve the same outcome?
As I say, I mean, it's contested. So, one can't say whether it is a simple or more complex way. Yeah. Any economy, if your economy is in trouble as a country, you really have to think about what tools do you have. And central banks and the U.S. Federal Reserve decided that's the policy tool that they're going to be using. Now, I think really, the more important thing is we're sitting here in South Africa and the rest of Africa, how will it impact on us? I think the very first fear is that often what happens, what now if the Americans increase interest rates, because they've kept, as part of tapering, they've kept interest rates very, very low. Now, if they change it there and change it now, then we are going to have the impact in Africa. Now, the good thing is many emerging markets and Africans, we've been knowing it is coming. So there's been preparation for it. Unlike in January when it came out sudden to the world that the Americans just decided, we're going to ease on tapering. Now at least, a statement has been made already in June, July, that it's going to be eased out. So really, in a sense, a lot of the markets are actually prepared for it.
I mean, Mr. Gumede, do you talk about the effect that it could perhaps have on Africa and of course, the concern in Africa, but what can the developing world do to better prepare themselves for global economic shocks or even tapering and, all these concepts?
I think the first thing is, many African countries really, let's just bring it down to the African countries, often have not very well-developed financial markets. So often, this issue is not going to impact on them. But then there are other African economies, like the South African economy, the Kenyan economy, the Nigerian economy, who's a little bit more integrated into the global economy. Now, they, really what they need to do then is, they have to build up to try to see that they have at least foreign currency. And secondly, what they need to do is, as Africans, to start to really to trade with each other in the region in their own currencies. Because, the problem is, for many African countries, when they go out to borrow money, they borrow it, of course, in foreign countries, and mostly the US dollar. So if there's any change in the US monetary policy, it directly impacts on African countries. So African countries really, I think, very, very importantly, they really have to improve their own monetary policy, their own economic policy, because often the countries that suffers if there's a change in, say, the economy of the US or other industrial powers, are those emerging market countries and African countries that are poorly governed on an economic and political level.
All right, thank you very much for your time. So that's Mr. William Gumede, our resident geo-economic analyst, speaking to us from our Johannesburg studios.